Good morning, friends. If you want to ensure that your investment grows and beat inflation and you become financially free, you have to avoid one very serious mistake that most of the people commit. What is that mistake? This video will tell you. Please see this video to the end and ensure that you don't commit that mistake. Friend, I am Ramchandra Rai and you are watching Prayas Vikal, a channel which is fully dedicated for development of your personality. It makes you effective, strong and successful. Friend, I have got 40 years experience in the area of finance. Based on my long experience, I have come up with the video series on the topic financial intelligence. This is the last video of that series, fifth part. Here I am going to discuss a very serious mistake which people commit, because of which they lose their investment. They lose their money in the market. What is that mistake? This video will tell you. Therefore, I will request you to please see this video to the end to know that mistake so that you can avoid it. If you find any value in this video, then share this video with your friends and subscribe to our channel. Now let us discuss this issue. Friend, before I go to the mistake which you can commit, let's understand what is investment, what are options available to you, what are risks involved, what you have to do. Friend, if you have got some savings, some money you have, if you don't want to take any risk, then just put it in some bank deposit. You will get some fixed interest rate, 7%, 8%. Your capital will be intact. Maybe you don't beat inflation. Some deterioration will take place in value of your investment, but it will remain largely intact. If you want to take some more risk, then you can select a balanced mutual fund. Balance means which have got equity part and debt part. We will understand these two things separately. Let us first talk about equity. Whenever a company is formed to do some business, it requires capital. Owner bring capital in form of equity, shares. Suppose a company is bringing equity, 10,000 equity shares, and you buy 100 out of that. That means you have 100 share out of 10,000 share in that company. So you are part owner of that company. If that company performs very well, whatever service or product it is providing, it has good market, quality is good, demand is good, growth is there, certainly it will become profitable after some time. And profit is indicated by earning per share. If 10,000 share is there and 1 lakh profit is there after tax, so you can calculate earning per share. Now, if this earning per share grows year after year because of good market, good product, good service, good management, then the value of share will also increase. Roughly, it is assumed that earning per share per year, if discounted for 30 years, coming 30 years, whatever value is coming, that should be the value of the equity share as on date. Suppose book value of a share is 10 rupees, and it is trading at rupees 50 in the market, that is 5 times of the book value. Or you say that earning per share is 5 rupees and it is trading at 50 rupees, so price earning ratio is 10. You can go even up to 30, price earning ratio up to 30, that can be fair price, provided growth is there. So this way, equity share grows, you get dividend, or value is appreciating. If you sell that share, you will get that much money. This is about equity. Then company takes some loan to fund its business. Loan, it has to pay fixed interest, whether to bank or it can bring a debenture or bond to the public, and they have to pay regular interest to the investors who have invested in its bonds or debenture. So balance fund means maybe 60% of money of that mutual fund is invested in equity shares of various companies, and 40% is invested in the debenture of the few companies. So this way risk is somewhat reduced. If you want to even take less risk, you could simply go for debt fund. So it is totally invested in debentures or bonds. So they are fixed interest rate you get, then you have to pay tax, etc., on that after putting the benefit of indexation. So first debt fund, least risk, then balance fund which has got some more risk, then pure equity and growth fund can be there, or dividend option may be there. There the money is invested in totally in equity shares. Now suppose a mutual fund has got say 10 crore rupees corpus, it will invest maybe say 50 shares it has invested, various type of share, mid cap, small cap, whatever. So there are sectorial mutual funds are there. Some mutual fund invest only in small cap, mid cap or large cap. There are sectorial funds like infra fund or tech fund or general funds. So these are range of financial products which are available in the market. And if you want to take even more risk than that, you can directly buy equity shares of the companies. They have to select company yourself, invest in it and earn out of it. Now you can do this business yourself if you know something about it. Like I have discussed in my earlier 4 videos, that if you know that what is the public finance function, what is corporate finance, what is personal finance, if you know all these concepts, maybe up to some extent you can do yourself. But I will advise that please select a professional advisor, personal finance advisor, who can advise you properly, guide you, take care of your investment. Now, the most serious mistake which normally investors are committing, that they are not selecting correct type of advisors. Now, what is correct type of advisor? Correct type of advisor is one who takes care of your interest. He has no other interest than you. Now today, friend, there are so many banks or other institutions where you are having your account. They have also their own financial products. They have got mutual fund, debt fund, hybrid fund, or pure equity funds. They want to sell their product to you. Now they have got relationship managers in every bank, and once they know how much balance you have got your saving account, they will be after you that please invest this money, I will get invested, you will get lot of return, all those things. They will tell you. Now the question is, these relationship managers, so-called advisors, how they survive? They get salary from the bank and they get commission also from the bank, very attractive commission. So they are inclined towards bank and towards its product, not towards your interest. Now friend, if you go to any investment app and if you check, suppose you check equity growth fund, there are 50, 60, 70 type of equity growth funds are available from various service providers, various companies, various banks. And if you see the performance, top 5 performers, maybe they are giving plus 20% return per annum. And if you see 5 bottom, they are giving 7-8%. So do you see the difference? 8% and 20%, 25%. This is the type of variation in performance of various type of mutual funds belonging to various type of banks, etc. Same thing happens in balance fund, same thing happens in debt fund. Now the question is, how an advisor will select best fund for you which will give you best performance? If he is not inclined towards your interest, he will certainly not do it. He is interested in selling his own product of his own bank, or maybe he is getting commission from the mutual funds for getting them sold to you. Then he will bother about the mutual fund which gives him maximum commission. Why he will bother about you? So friend, never commit a mistake of selecting advisor who is biased against you because of financial incentive he is getting from other party. Always check whether he is SEBI registered or not, or even if he is not registered, he should charge from you and he should survive on your payment, not on the payment made by mutual fund or his bank or other institutions, because there is a clear-cut conflict of interest. Your interest and his interests are not same. They are not aligned. Then how do you expect that he will give you correct advice or manage your money properly? So please never commit a mistake of selecting advisor who has got conflict of interest. Select advisor only one who purely survives on your money. You can pay him annual charges as a percentage or fixed charge, whatever it is. But don't select an advisor who is committed towards other party, opposite party. That means the party who is selling you the mutual fund or other financial instruments. If you take care of this thing, I am sure that you will protect yourself from the risk of bias and your investment will be intact. An advisor should advise you from time to time what he is investing, why he is investing, what is the ranking of that fund in the overall performance in the market. So if you do that, I am sure that you will not lose money. You will beat competition and you can become financially free one day. Friend, I will conclude by telling that please select a unbiased financial advisor if you want to see that your money grows in the market. Friend, if you find value in this video, please share this video with your friends and relatives so that they can also benefit from it and they don't commit this serious mistake. Also, always try to see, listen, and write good things. Read good things so that good information enters you. You improve day by day, your personality improves day by day, and chances of success also improve day by day. Friend, next video I am going to come with to you on the subject of how to manage toxic behavior in an organization. This is a pandemic today and it affects you very badly. Till I come with the next video, please take care of yourself. Be happy, be healthy, and keep on improving yourself. Thanks a lot for giving me so much time. I am sure that you are going to make this video viral. Thank you again.